Welcome back to the deep dive. Today, we are parking the time machine in late May 2025. And honestly, it is a fascinating and frankly a pretty tense moment to be looking at the tech landscape, specifically if you've been following the absolute roller coaster that is Nvidia.
It really has been. It feels like a year of two completely distinct halves, and we aren't even halfway through the calendar year yet.
I know, it's like we've lived through a decade of market cycles in just 5 months.
Something like that, yeah.
Exactly. And look, whether you're an investor white-knuckling your portfolio, a tech enthusiast, or, just someone wondering why your newsfeed is constantly obsessed with GPUs, this deep dive is for you. We're sitting here just days away from Nvidia's Q1 FY2026 earnings report that's scheduled for May 28th. So the mission today is simple. We need to cut through the noise.
And there's a staggering amount of noise right now.
It's deafening, because if you rewind the tape to the start of the year, the narrative wasn't growth, it was doom. It was panic.
A total panic.
But now, as we sit here in late May, the mood feels stabilized, maybe even cautiously optimistic, but definitely different.
I'd call it informed stabilization. If I had to summarize the thesis for this whole deep dive, it's that we are witnessing a transition.
A transition from what to what?
From a phase of, let's call it panic about disruption back in January, to a reality check here in May. The sky didn't fall.
Okay.
And the reason it didn't fall is what we need to unpack. The big four tech giants are still spending astronomical amounts of money on Nvidia hardware, no matter what the headlines say.
Okay, let's unpack that. I want to start with the panic because it feels like a distant memory now, but in January, it was the only thing anyone could talk about, DeepSeek shock.
Right. To understand where Nvidia is today, in May, you have to understand the scar tissue from January.
So rewind the tape for us. It's January 2025. A Chinese firm called DeepSeek drops a model called R1. Why did this one thing freak everyone out? We see new models every week.
Yeah, but this was different. It wasn't just that it was a new model, it was the economics of it.
The economic.
DeepSeek released this AI model that was shockingly good performing, right near the top of the benchmarks. But the kicker was how cheap it was to train and run. It was a massive efficiency breakthrough. They basically claimed they achieved GPT-4 level performance for a fraction of the compute cost.
And normally in any other industry, that sounds like good news, right? Cheaper AI means more adoption.
For the users, absolutely. For software developers, it's a dream. But for Nvidia investors, it looked like a nightmare.
Why?
The fear was instant. Investors looked at Nvidia, whose whole business model is selling these premium, Ferrari-level chips for $30,000 or $40,000 a pop.
And they thought, wait a minute.
Exactly, wait a minute. If AI models are getting super efficient, maybe companies won't need to buy thousands of these H100s or Blackwells anymore.
It's the idea that good enough is the enemy of perfect. If I can run a decent AI on a cheap chip or just use fewer chips, why am I paying the Nvidia tax?
Precisely. That was the whole narrative. It caused massive volatility in Nvidia's stock early in the year. The assumption was that the moat, that defensive trench around their business, was gone.
Software was eating hardware.
That was the logic, yes. But, and here's the crucial pivot for you, we are now in May, and that collapse just didn't happen.
So play devil's advocate for me here. If the tech did get more efficient, and DeepSeek proved you can do more with less, why didn't demand drop? Why are we still seeing these massive orders?
Because the market realized there are two completely different games being played here. You have to distinguish between inference and training. That distinction is what saves the bull case.
Let's define those quickly for everyone, just so we're on the same page.
Sure. Inference is when you use the AI. You ask a chatbot a question, it gives you an answer. That's inference. Efficiency is great there. You want that to be cheap and fast.
Okay.
But training is when you're actually building the brain, teaching the AI to be smart in the first place.
So inference is the car drive, training is building the engine.
Roughly, yes. Good analogy. And for training the next generation of super intelligent models, the arms race hasn't slowed down one bit.
So it's like saying, just because a Honda Civic is great for commuting, Formula One teams are going to stop buying high-performance engines.
Perfect analogy. No, Google and Meta aren't trying to build a Honda Civic.
They're trying to build,
A good chip.
The fastest, smartest reasoning AI on the planet. And for that, efficiency isn't the priority. Maximum raw power is. The demand for maximum compute to train these massive models is what kept the floor from falling out.
So the disruption happened, the tech got better, but the hunger for raw power just remained because the goals shifted to harder problems.
Exactly. The goalposts moved. We went from make a chatbot that can write a poem to make an AI that can cure cancer or solve fusion. For the latter, you need the biggest computer you can possibly build.
And the market just adjusted to this new reality.
It did. The sky didn't fall, and Nvidia kept selling. Which brings us to the scoreboard. Before we look at the upcoming May 28th report, we need to contextualize where Nvidia left off. In February, they reported their Q4 FY2025 results. And the numbers were, well, huge feels like an understatement.
Huge, was putting it mildly. They posted record quarterly revenue of $39.3 billion. That was up 78% from the year before.
Nearly $40 billion in 3 months. I remember when that was a good year for a tech company.
It's staggering. And the vast majority of that $35.6 billion was just from the data center segment. That's the chips we were just talking about.
And I remember Jensen Huang, Nvidia's CEO, making a comment during that February report that really stuck with me. He talked about scaling laws. It sounded almost like a law of physics.
In this industry, it basically is. This is the intellectual anchor for the whole bull case. Jensen said demand for Blackwell is amazing.
Blackwell is their newest, most powerful chip.
Right. But his point about scaling laws is what matters. He basically argued that increasing compute for training just flat out makes models smarter.
So, simply put, bigger brain needs more power.
Right. But it's nuanced. He added that increasing compute for long thinking makes the answer smarter. This is that reasoning AI concept again.
Long thinking.
Yeah. If you want an AI that doesn't just regurgitate text but actually thinks through a problem, like solving a complex math proof or coding a new app, you need massive computational horsepower.
And this philosophy that compute equals intelligence is why customers are just ignoring the DeepSeek efficiency narrative and keeping their wallets open.
Correct. They're betting that the laws of physics apply to intelligence. More power in, more smarts out.
Okay, so the philosophy is more power equals smarter AI. But philosophy doesn't pay the bills, cash does. So who is actually footing the bill right now? Because $40 billion a quarter doesn't just appear out of thin air.
This is where it gets really interesting, and you can argue this is the biggest risk factor for the company. We're looking at a very concentrated group of buyers.
Okay.
We call them the big four hyperscalers.
The usual suspects.
The usual suspects. Meta, Microsoft, Alphabet, Google, and Amazon. These four companies alone account for roughly 53% of Nvidia's revenue.
Hold on. More than half the business is just for customers. That sounds fragile.
It is.
I mean, if one of them sneezes, Nvidia catches a cold. If one of them decides, okay, we have enough chips, the stock crashes.
It is incredibly concentrated. It's a valid concern. But when you look at their spending plans, the sneeze doesn't seem likely. Not yet, anyway.
Why not?
The combined capital expenditure, or capex, for these giants in 2025 is projected to exceed $320 billion.
$320 billion. That is, I mean, that's the GDP of a medium-sized country. That's Finland.
It is. And analysts estimate that about 50% of that infrastructure spending flows directly to Nvidia.
About 2%.
So we are talking about roughly $160 billion in annual demand coming from just 4 boardrooms.
But why? I get the arms race idea, but $160 billion, at what point do shareholders at Microsoft or Google revolt and say, stop spending our dividends on GPUs? It feels like they are lighting money on fire.
Well, look at what they're doing. Microsoft Azure and Google Cloud are frantically expanding their AI services. Meta is spending somewhere between $64 and $72 billion this year alone, largely targeting generative AI.
It feels like a high-stakes poker game where no one is allowed to fold.
That is exactly what it is. It's a prisoner's dilemma.
Walk me through that. Why can't they just, agree to slow down?
Okay, imagine you're the CEO of Google. Even if you wanted to save money and use cheaper chips or slow down your spending, you can't.
Because if you do.
Because if you slow down and Microsoft doesn't, Microsoft gets the smarter model. They win search. They win productivity. You become obsolete.
So you have to spend the money just to stay in the game. It's defensive spending.
Exactly. As long as they are fighting for AI dominance, Nvidia acts as the arms dealer. They are shielding Nvidia from those efficiency concerns we talked about earlier. They are trapped.
So DeepSeek says, hey, we can do this cheaper. And Google says, I don't care. Give me the Blackwell chips. I need to beat Zuckerberg.
Precisely. The fear of losing is a much stronger motivator than the desire to save money.
Okay, so that's the big four. We know they're spending. But here's the twist for our May 2025 snapshot. We just had some breaking news out of Computex in Taiwan that suggests the customer base might be starting to evolve.
Yes.
It's not just Silicon Valley anymore.
This is the pivot point. We've been talking about chatbots and search engines, but the news from Computex, It's about the physical world.
You're talking about the Foxconn deal.
The Foxconn deal, this was announced just days ago in mid-May. Nvidia and Foxconn are partnering to build a massive AI supercomputer in Taiwan.
And the specs on this are pretty intense, right? It's not just a standard server room.
Very. It's going to feature 10,000 Nvidia Blackwell GPUs. It's planned to have a 100 megawatt capacity, rolling out in phases.
10,000 GPUs. That is a serious piece of hardware. But why does this matter? Foxconn makes iPhones. They don't run a search engine. Why do they need a supercomputer?
That's exactly why it matters. This isn't about generative AI for writing poems or code. This is a move into physical AI.
Physical AI.
Foxconn is the world's largest electronics manufacturer. This supercomputer is designed to drive Taiwan's tech ecosystem and, smart manufacturing.
So using AI to run the factories that build the tech.
Exactly. Robots, automated assembly lines, digital twins of factories. Jensen Huang calls it the next wave. We've taught computers to think. Now we are teaching them to move and build.
And it's not just Foxconn, right? I've seen headlines about sovereign AI. That sounds like a sci-fi movie concept, but what does it actually mean here?
Basically means national AI. We're seeing deals in the UAE, Saudi Arabia, Qatar. These aren't tech companies. These are nations. They want their own AI infrastructure.
Why? Why not just use Amazon Web Services?
Security. Independence. They don't want to be dependent on U.S. cloud providers for their national intelligence or their government data. They want the brain to reside inside their own borders.
They want to own the compute.
They want to own the compute.
Yeah.
And that's a fascinating layer of diversification. If Microsoft slows down, maybe the Kingdom of Saudi Arabia speeds up.
It diversifies the risk. It shows that Nvidia is transitioning from selling to just tech companies to selling to industrial giants and nation states.
It broadens the base significantly.
Which brings us to the main event. All of this, the DeepSeek recovery, the Big Four spending, the Foxconn deal, it all leads up to May 28th. The Q1 FY2026 earnings report.
The moment of truth.
So what should we be looking for? If I'm listening to this and I want to know if the party is continuing, what are the numbers?
Well, first let's manage expectations. The boring truth is that the law of large numbers is kicking in. We shouldn't expect those wild triple-digit jumps we saw in 2023 and 2024.
The rocket ship is reaching cruising altitude. You can't double forever.
Exactly. The projected revenue guidance is around $43.0 billion. That's plus or minus 2%.
And that's up from the $39.3 billion we saw in February.
It is. Now, looking at that year over year, that's about 51% growth.
51% growth is still incredible for a company this size. I mean, most mature companies fight for 5 or 10%.
It is massive. But, and here's the nuance, if you look quarter over quarter, from February to May, the growth might be flat, or maybe up to 10%.
Yeah.
It's not doubling every 3 months anymore.
The curve is flattening slightly.
Right.
And I saw some analysis suggesting earnings per share, or EPS, might actually dip a tiny bit.
Potentially. Estimates suggest EPS might decrease by 2–3% quarter over quarter.
Wait, revenue goes up, but earnings go down. How does that work? That usually freaks investors out.
It's the cost of growth. Seasonal patterns play a role, but also operational expenses are ramping up. They're spending heavily on R&D for the next chip, and the cost of deploying all this new Blackwell technology is high.
I see.
But year over year, EPS is still up massive amounts, around 42%. So don't let a tiny quarterly blip scare you.
So if the demand is there, if the Big Four are spending $160 billion, why is the growth flattening out quarter to quarter? Why isn't it $50 billion this quarter?
Supply. That is the one word you need to listen for on the earnings call. Supply.
They literally can't make them fast enough.
The constraint right now isn't people wanting to buy chips. It is TSMC, the manufacturer, being able to print them and package them. The Blackwell ramp-up is the key phrase. Are they shipping them fast enough to recognize the revenue?
So if they beat that $43 billion number, it's likely because they managed to squeeze more chips out of the factory than expected.
Exactly. It's a supply chain game right now. The order book is full. The delivery trucks are the bottleneck.
So putting it all together, we started the year with people screaming that cheap AI would kill Nvidia. Now we are in May, and they're predicting $43 billion in revenue for a single quarter.
It's a testament to how sticky this technology is. We went from the DeepSeek panic to a stable, high-growth reality.
And the customer base is shifting from just guys in hoodies in Silicon Valley to manufacturers in Taiwan and governments in the Middle East.
Nvidia's transitioned. They aren't just a speculative tech stock anymore. They are becoming a fundamental infrastructure company.
The power plants.
They're building the power plants of the AI age. And just like you don't stop buying electricity because you've found a more efficient light bulb, These companies aren't stopping their purchase of compute.
That's a great way to put it. They are the utility company of the future.
They are.
Yeah.
And utility companies are usually pretty good businesses.
Before we wrap up, I want to circle back to that Foxconn deal one last time. You mentioned physical AI.
I think this is the sleeper story. This is the thing people will be talking about in 2026.
Tell me more. Why is this bigger than ChatGPT?
Well, think about it. We spent the last 2 years using Nvidia chips to teach computers to manipulate pixels and text, writing poetry, generating images, writing code. That's the virtual AI world.
Okay.
But the Foxconn deal and this push into robotics, this is different.
How so?
This raises an important question for everyone listening. Are we about to see what happens when Nvidia chips start teaching computers how to move and build in the real world? Because if you think about the global economy, manufacturing, logistics, transport, agriculture, that is a much, much larger market than chatbots.
That is a wild thought. We've been worried about AI taking our writing jobs, but maybe the real money is in AI driving the forklift and assembling the car.
And if Nvidia is the brain inside every robot and every smart factory, $43 billion a quarter might just be the appetizer.
A terrifying and exciting thought to leave us with. We will be watching that May 28th earnings report very closely to see if that Blackwell ramp-up is on track.
That's going to be an interesting week.
It always is with this company. Thanks for joining us on the Deep Dive. We'll catch you on the next one.
Take care.